Yeah, welcome to this side event in the last round of side events of the Vienna Energy Forum. We will dive into the financial sector this time. And we have a great list of speakers, panelists lined up for you. My name is Bas van Ruijven. I'm the research group leader for the Sustainable Surface Systems research group at IASA. And over the past year, I've worked actually with all of the speakers here on either developing scenarios for the finance sector or thinking about how they can be improved in the future. And so that's why we have brought in Edo Schets, manager from the Climate Hub at the Bank of England, as a first speaker to talk about the relevance of the climate change for the finance sector and the other way around. Then we have Jérôme Hilaire, from the Potsdam Institute of Climate Impact Research to talk about the new scenarios that have been developed for the NGFS. And then we end up with Irene Monasterolo from the Wirtschaftsuniversität in Vienna on how we can improve scenarios and the role of the climate sector in scenarios in the future. If you have any questions, we have two ways of putting them in. There is a Q&A button at the top right of your screen. If you put them there, we will take them up orally, either per speaker or at the end of the session. If you have direct questions, you can also ask them in the chat, and the panelists can also directly reply there, and we can see how things evolve. So let's start with Edo Schets. As I said, manager of the Climate Hub at the Bank of England, to talk about the role of the importance of climate change for the financial sector.
Thanks, Bas, and thank you also for inviting me here. Very excited to be at the Energy Forum. It's a bit of a different audience from what I'm used to working at a central bank. Now, I'll just try to share my screen now. Okay, hopefully you're able to see that, and I'll quickly turn it onto my slides. Can I just check, are you able to see the slides?
Great. Yes, perfect.
Okay. So as Bas mentioned, I work in the Climate Hub at the Bank of England. And if you're not familiar with our work, you might wonder why a central bank has a climate hub. So I hope that in today's presentation, I'll be able to explain that a little bit. And I should maybe say in advance that the Bank of England is doing a lot of work actually on climate at the moment. And my focus will be a bit more on climate scenarios for the purpose of today. But I think all the climate work comes from mainly one single source that we do, which is that climate change can have a significant impact potentially on the financial sector. And that's why we as a central bank are concerned with it as much as many other groups are. So why is that? Why could it affect the financial sector? Well, this is a chart that perhaps for many of you should not come as a surprise at all, but it just shows in a very crude way how as global GDP, global economic output has been growing, we also see that global energy use has been growing. And economic output and energy use are very much intertwined. Sorry, was that a question? Okay.
Go ahead.
Thanks. Are very much intertwined. And of course, that energy use produces emissions, and those emissions lead to the greenhouse gas effect, lead to global warming ultimately. So this part I expect you all know, but the key message here is that economic activity is very much intertwined with that process of creating emissions, at least at the moment. And that will need to change if we want to put a halt to global warming. But whether we change it or not, or whether we succeed in limiting our emissions, in fact, bringing them back to net zero emissions, or not, there are going to be some risks. These risks don't always have to materialize, but they could materialize. And this chart kind of shows how in all the different kinds of states of the world that we might have going forward, you could have different kinds of risk. So what we see here is an emissions pathway, carbon dioxide emissions. This is kind of an old projection, so it's not up to date. So I think if you were to make this chart with today's data, you'd probably see kind of the upper side of emissions a bit lower, because things have already changed since 2017. We've become more efficient. But still, even with slightly lower emissions on the upper end, you're going to end up in a world of significant global warming. And that, of course, has all kinds of effects on nature, on climate, that will ultimately also make their way to the economy. And we call these physical risks. So you could think, for example, of a flood happening that affects your property, or a forest fire that affects property, businesses, etc. And of course, there are many more physical perils. I won't go into all those details now, but those physical risks could affect the economy in many ways. On the other hand, there are a lot of commitments being made at the moment to reach net zero emissions. Here in the UK, we have committed to reaching net zero emissions by 2050. So essentially reducing the emissions that we make as we produce economic output. And even if we do that and we curtail kind of the physical risks from climate change to a minimum, that process in itself would be a huge structural shift in the economy. And that shift is not without risk either, especially for financial institutions that are lending to all kinds of companies, that are investing in all kinds of companies. Such a structural shift could dramatically change the outlook of certain companies, certain sectors in the economy. And so that could then create risks for financial institutions. I'll say more about this, but this was just kind of a first impression of what these risks are. So going into a bit more detail, one concept that we often talk about when thinking about financial risk from climate change is stranded assets. And stranded assets is a concept that essentially says there are certain assets that are valued today on balance sheets of investors, of financial institutions, that might lose their value as a result of especially this transition. So for example, a company that has a lot of oil reserves might find itself in a situation where regulations or a shift to renewable energy makes those oil reserves no longer economical, no longer viable. So today they might assume they're going to get X amount of money from those oil reserves in the future. But if the economy changes and that oil is no longer needed, then they will never realize that value. So a lot of asset value could become lost, could disappear as a result of the transition. Now, from a financial perspective, climate risks are actually a bit different from many of the risks that we typically look at. So for one, they're very far-reaching. I mean, they're global in scope. They could affect literally every asset in the economy in some way, because a structural shift affects everyone, not just the companies that can no longer sell their oil, but also companies that use energy, for example, that will see a change in energy prices, perhaps. So it's far-reaching. It's also non-linear, I think, especially with the physical risks from climate change. As the world gets hotter, those intensify, and we might see that kind of the economic losses that result from that could go up in an exponential fashion. And it's also irreversible. So we know that if we are able to succeed to limit or to reduce our emissions to about net zero around 2050, the IPCC report on 1.5 degrees says that, well, in that case, you're likely to limit global warming to 1.5 degrees, and as a result, limit the physical risks from global warming. But you won't eliminate them. There will be some physical risks for sure that we've already created from the emissions that we have already put out in the atmosphere in the past. So this process is to some extent irreversible. It's also foreseeable. So we don't know if we're going to be in a 1.5 degree world or a 4 degree world, but we know that one of those worlds is going to materialize. That we know for sure. And we know that each of those worlds will have its own risk that come with it. But of course, there is that uncertainty of which one is going to materialize. And then finally, this is all dependent on the actions we take today. So compared to a lot of traditional financial risks that we worry about, a loan to a homeowner who takes out a mortgage and pays it off over time, we worry about that homeowner no longer being able to pay off their mortgage. But climate risks kind of have this far-reaching scope that could affect everyone over a long period of time. We know it will, we just don't know how. And it all depends on what we do today. So that makes it very complex, but also very important for us to already look at today. So on this next slide, I have a lot of detail, and I won't go through all that detail now. But this is just to give an idea. This is a slide taken from work we have done in the Network for Greening the Financial System. That is which we always call the NGFS for short, which is a group of central banks and supervisors that work together on these climate risk issues. And so this is just a chart kind of depicting how you can go from climate risks on the one hand, the transition and physical risks, to impacts on the economy, both at a microeconomic level, so individual households and businesses might be affected, but also macroeconomic. For example, those stranded assets that I mentioned could have quite a broad impact on the macroeconomy by just making a lot of value that's there now disappear. So those risks could materialize, and then ultimately that affects the financial institutions that finance the economy, the investors and the banks that lend to businesses and households, etc. So that brings me almost to the end of my talk, but I just wanted to say a few words on what we are doing as Bank of England and in fact as many central banks in the Network for Greening the Financial System to kind of get a better grip on these risks. We've put out climate scenarios together with Bas from IASA and many other academics. So you might hear more about those in the next talks. But I just wanted to say briefly, we developed those scenarios because we want to get a better sense of those risks, but we're not climate scientists. So we try to kind of get that knowledge in from outside. And we did that by combining our forces as central banks in the NGFS and coming up with a common set of scenarios, because these scenarios are global in scope anyway. Global warming is a global phenomenon. And so we published a first batch of them last year in June, and a brand new batch on the 7th of June this year. And so you can download them on the NGFS website, or you'll find a link to all the scenario data. I won't go into the details there, but we put out these scenarios and are using them to kind of analyze all these different climate risks that I've described. And to make that a bit more concrete, so this is just one picture of what you can find in those scenarios. This is projection of GDP impacts that we've produced. And what you see here are three scenarios. One where we achieve net zero emissions in 2050 globally. One where we manage to curtail global warming to 2 degrees by the end of the century, but we start in 2030 instead of today. And so that gives us a shorter window of time to make the changes necessary in the economy to reduce those emissions. And that's why you see that the GDP impacts are bigger in that delayed transition than in the net zero 2050 scenario, where we start today and kind of move swiftly to a net zero emissions world. And then finally, a current policy scenario where we don't transition at all. And so in the short term, the impacts are 2030, 2050, you see the impacts on the economy are a bit similar to the first two scenarios. But then in the long term, by the end of the century, we get the full effects from global warming. And such a scenario is, of course, much more impactful from an economic perspective. So that's just a sneak preview, I guess, of what these scenarios are. And then we are using them at the Bank of England, and other central banks are doing similar things. In a climate scenario exercise, we've launched one on the 8th of June of this year, which we call the Climate Biannual Exploratory Scenario. Don't try to remember that name, but it's Climate BES for short. And we've basically asked the largest UK financial firms, banks and insurers, to take these scenarios and think about how their balance sheets are going to be affected. How are their investments, how are their loans going to be impacted under these different states of the world of climate change? And we plan to publish results in Q2 of next year. So I think with that, I come to the end of my talk. That was just a brief introduction to the financial risks from climate change. Let me hand back to Bas.
Yeah, thanks a lot, Edo. That was very clear on why climate change is relevant for the financial sector. Let's move to Jerome, who will introduce us to the further actually into the concept of scenarios specifically developed for the finance sector. So Jerome, the floor is yours.
Yes, thank you, Bas. Can you see my screen now?
Yes, can see that.
Okay. So thanks for inviting me as well. It's a real pleasure to be here today, and in the next 15 minutes or so, I would like to talk about these NGFS scenarios, but from an integrated assessment modeling perspective. And to start off, I would like to provide an overview of what transition scenarios are, and this is what we will focus on here. I will not talk about physical risks, but only about transition risks. The first key message here to keep in mind is that scenarios are not predictions of the future. Over the past few years, scenarios have been features in a number of assessments by the IPCC and UNEP in order to inform policymakers and broader societal actors about the transition, about the energy transition. And these transition scenarios come in usually two flavors. They allow us to explore what could happen, and they are akin to deep-down projections. So, for instance, we could assume that governments will keep those policies that are currently implemented and will not introduce new ones for the rest of the century. This is an assumption that we can make, and in that case, we can see that scenarios, that warming in these scenarios would reach about 3 degrees by 2100. The second flavor is a more normative one, and allow us to understand what should happen. For example, if we we're aiming at keeping warming below 1.5. So these are the type of transition scenarios we are talking about. A second important message is that it is mostly useful to look at an ensemble of scenarios and particularly to compare pairs of scenarios. And the reason is that a single scenario might be very different across models, but its results are much more robust when we look at differences between, for example, a 1.5 scenario and a baseline scenario. For instance, and this is also much more useful to policymakers, think about the additional investment needs in renewable energy technologies that you could infer by taking the difference between a 1.5 and a baseline scenario. And this is the kind of information that policymakers would need to devise policies to aiming at reaching the target. The third and important message is that scenarios, when we create scenarios, there's a context to it, and this context is usually much broader than the scenarios themselves. There's a lot of information in this context, and so that's why if one wants to use and understand scenarios, he or she they need to understand the context underlying those scenarios. And by context, when we take a modeling perspective, in that case, context means the models themselves, the integrated assessment models that we use, but also the assumptions that are inputted to those models. Integrated assessment models, or at least the kind of IAMs, integrated assessment models that we use to create the NGFS scenarios, are process-based detailed models, meaning that they have a detailed representation of the energy and land use system. They can provide information at the technology level for different vintages. But more generally, integrated assessment models try to bring together the 4 different systems that you can see in the middle of this slide, so the energy, land, economic, and climate systems, and try to reproduce the dynamics that occur within and between those different systems. And they enable users and developers to also uncover some of the non-linearities. Non-linearities are not only affecting physical risks, as Edo mentioned, but they are also present in those models, and such tools allow us to unveil those. To the assumptions, these can be broadly classified in four different categories. The first category is the socioeconomic drivers. So here we usually have GDP and population assumptions. And in the scientific community, we use a framework called the shared socioeconomic pathways, which we also have used for the NGFS scenarios. We have used the SSP2 assumptions for GDP and population, which basically means a continuation of current trends in GDP and population. And the little tweak that we added in this version of in the latest version of the NGFS scenarios were to add a coverage shock to the GDP. The next category is technology development. So here you can think about how technology costs could evolve in the future, but also the availability of technology is also a central assumption. Here, for instance, we can decide whether carbon dioxide removal technologies are fully available, or if their availability is subject to several constraints. Policy trends, the third category, would include any types of policies, including NDCs, so nationally determined contributions. And we can also consider in the NGFS for scenarios, for example, in the net zero 2050, we also considered under this category the net zero targets that some countries put forward. So in that case, it would be the EU, China, and Japan, for instance. And the fourth category of assumption is the climate protection ambition. And here, what we mean here is this is directly connected to this normative question of what if we want to reach the 1.5 degree target? So this would be the climate protection ambition. So here you see how vast, how complex this context is, and how it fully determines the output of these models, of the integrated assessment models, and so the scenarios themselves. As you can see on the right-hand side, there's a wealth of information that are provided by these integrated assessment models, including energy use, land use, emissions, investments, technology deployment, prices, GDP, consumption, and trade, and many, many more. And you can explore all this in the database. So now, looking a bit closer at the NGFS scenarios and at their assumptions, here you can see the kind of assumptions that we made to categorize, to define these different scenarios. So we have the 6 NGFS scenarios, and for each of them, you have here in the different columns, I don't know if you can see my cursor, but basically the 5 next column, last columns are basically drivers, levers that we made to define those scenarios. The first line is the net zero 2050. You will see that here for policy ambition, we had this 1.5 degree target. For the policy category, we have 2 different assumptions. So here on the policy reaction, there would be an immediate and swift reaction in the scenario across the world, and medium variation at the regional level. In terms of carbon dioxide removal, we assumed a medium use for this scenario. And so I will let you explore a bit more these assumptions. But these assumptions are directly connected to the transition and physical risks that Edo was describing before. And this allows us also to map these scenarios in terms of transition and physical risk on this space, which is a very interesting way to look at scenarios. And this already tells us that scenarios can be used to help us evaluate transition risks. And this is what we will look at in the next few slides. But before we get to these risks, I would just like to showcase a little bit the kind of results that we can get out of these models. So here you can see that the NGFS scenarios we describe transition in sectors. So we have in those models, as I said, they are very detailed. So we can have information about the electricity sector, but also about industrial sectors like steel, cement, chemicals, and also buildings and transport. And we can see here how relatively easy it is for the electricity sector to transition towards net zero, and how things are much more difficult for the steel and cement industry, for example, and also for transport. And here you have an example of another example is investment in energy technologies. This is also something that is uploaded by our models, and here you have a comparison between current policies and the net zero 2050. And what you see here is that, as expected, we need much more drastic increase in investments in green electricity and storage compared to the current policy scenario in red. Now, as I said, these NGFS scenarios can be used to start evaluating transition risks, and one way to do that is by, for instance, looking at carbon prices. This is the figure that you see on the right-hand side. If you look at the current policies in gray and the NDC scenarios, so these would be weak policy scenarios, and you can see that carbon prices in those scenarios do not increase dramatically, but these scenarios will lead to between 2.5 and 3 degrees of warming by the end of the century. In contrast, all policy scenarios above feature a much more dramatic increase in carbon prices. In the net zero 2050 in blue, you can see that carbon prices can reach nearly $700 per ton of CO2 by 2050. And we can use these data to get even closer to transition risk, and this was work pioneered by UNEP, Weimann, Peak, and IASA in 2018, I think. This team came up with a framework called the risk factor pathways that translates scenario data into useful information for financial risk assessment. Here is an example of these risk factor pathways for utilities. The top figure shows direct costs, so the direct costs would be correspond to those that come from greenhouse gas policies. So basically, the price that utilities would pay as a result of an increase in carbon prices. And you have indirect costs that come from increase in energy prices. Here you can think of, if you have a coal power plant, for instance, how coal price will evolve in a net zero in comparison to a current policy. Here it will increase slightly, so these indirect costs are not as high as the direct costs. You can see that there are increased in capital expenditure in low carbon alternatives. And there's this fourth risk factor pathway, which is revenue. And in that case, coal power plants would lose quite a lot of revenues because of competition with solar and wind technologies, and so affecting their balance sheet, ultimately making them unprofitable. We could, using this NGFS scenario data, we can also look at how oil prices are impacted by introducing climate policies, and here you see how the oil volumes and oil prices would decline in such a scenario. I just would like to mention that the NGFS and IEA net zero scenarios are well aligned. And to finish, I would like to invite you to visit the NGFS scenario portal to have an introduction about these scenarios. You can also explore a little bit the data underlying these scenarios, and also have a direct access to the data and resources. And with this, I finish my presentation. Thank you.
Thanks a lot, Jerome, for diving into the details of the NGFS scenarios that were developed specifically for the financial sector. Now we are very happy to have Irene being back online as our last speaker here.
Hi.
Hi. I am going to share the screen to actually share your presentation so that you can talk through it.
Thank you so much,
So you
and
should be able
sorry
to see
for the problem with the internet connection. Yeah, I can see the presentation. Thank you so much, and thank you so much for the invitation. And I'm very glad to be sharing the floor with this very interesting and timely topic with the panel. Today I'm going to present the joint paper co-developed together with Bas van Rooyen and K1 Riai at IASA and Stefano Battiston at the University of Zurich and Ca' Foscari University of Venice. Why this paper today? Because it complements actually the discussion that we have been having on the development of climate scenarios for financial risk assessment, and in particular in the context of the NGFS. The paper is titled "Accounting for Finance is Key for Climate Mitigation Pathways," and now we will see why. Next slide, please. Next slide, please.
Are you not seeing the next slide?
No, I don't see it. So let's do this. I will read on mine. Okay, great. So I will read on mine, on my screen, and then I will tell you when to change, okay?
Yeah.
So also the others will see. Great. So let's start with a few take-home messages. First, there has been growing attention on the role of finance for the low-carbon transition by financial supervisors, and indeed, the NGFS has developed climate transition scenarios based on the climate mitigation pathways developed by integrated assessment models. These scenarios, as you both discussed before, became a reference tool for supervisors, but also for investors, and in particular to guide investors' climate stress test. Since they are endorsed by financial supervisors, they have the power to shift market expectations. However, the same NGFS scenarios do not account for the role of finance in the realization of the same scenarios. And in particular, the concept of endogeneity of climate risk is missing in the scenarios. What does it mean? It means that the fact that investors are looking at the scenarios and could adapt their expectations of risk of investments, in particular low carbon and high carbon, across scenarios is missing in the scenarios. Thus, there is the need to embed this feedback loop in climate mitigation scenarios to analyze the conditions for finance to enable or hamper the transition. In particular, by embedding the feedback loop of investors' expectations and scenarios, this could lead to understand the condition for underinvesting with regards to the climate targets, and thus the possibility of achieving or missing the transition pathways that are modeled. This is key for the political economy of the transition to a low-carbon economy, and in particular for the design of fiscal and financial policies that are really effective. What we do is to develop a framework to model the interactions between investors' expectations, climate policies, and the realization of the climate scenarios to generate new climate transition pathways that are more coherent with the investment needs to achieve them and the climate targets. The paper was recently published on Science and is accessible at the link that you can see.
And then it seemed that we lost the speaker again. That is unfortunate. Maybe she comes back, but for the time being, I can continue with this presentation, being familiar with this work. It builds upon an existing approach that Irene and Stefano Battiston had developed for climate stress testing. The method that they had developed would translate integrated stress model trajectories into financial shocks on securities or other assets, and in terms of price adjustments of those assets. And that work also introduced the concept of climate policy relevant sectors. So a set of sectors based on the NACE codes of economic that describe economic activity that are the most relevant to climate policy impacts. And they ran a climate stress test for the financial system and individual institutions to see how individual investor portfolios or certain companies would be impacted by the risks from climate policies. And this approach has been applied a lot since then with the ECB, with EIOPA, the European Pension Fund supervisor, and now we have also used this approach actually with the NGFS climate mitigation scenarios. And Irene is still not back, so I continue here. So the NGFS scenarios themselves, as just presented by Jerome, are developed with integrated assessment. And as also Jerome highlighted, these are not predictions, they are explorative paths forward, given sort of under what if considerations. What if we take these measures, what will the future then, what might the future then look like? So they focus on key dimensions, right? The timing of introduction of stringent climate policy, whether that happens now or whether that happens with delay, different levels of the climate target, whether we go for 1.5 degrees or 2 degrees, and different levels also of reliance on carbon dioxide removal at the end of in the second half of the century, and so how much we basically postpone the transition or not. However, in the integrated assessment models that were used to develop these scenarios, the finance sector is not dynamically included. It is, and so implicitly, basically what the models do is assume that finance is available equally to all of the sectors within the energy sector, and they have all, so equal access to finance, basically. One example here of that is here, for example, focusing on China in the Remind model in the NGFS scenarios, how electricity generation from wind on the left graph and then coal on the right is developing in the different scenarios. And what you see for wind is that the current policy in dark red at the bottom sort of is the lowest projection of wind. But then if you have immediate 1.5 degrees, you have a much higher penetration of wind. And if you have sort of a delayed climate policy, you have later scale-ups in wind energy. At the same time for coal on the right, you see current policy still maintaining some coal power generation. But then it's being phased out at different paces, basically depending on the scenario that you assume. And then when you're a utility firm that seeks to shift its power plants basically from high carbon to low carbon technologies, it really depends on the financiers and the institution that providing you with financing and loans, under what conditions actually you can be financed, depending on which of these trajectories the banks and your financiers actually deem the most likely and how they view the future. If a bank perceives a low carbon strategy as less risky than the status quo as the current situation, then they might lower the interest rates on the loan for wind energy companies, and in that way facilitate and enable the technological conversion towards low carbon technologies. But banks might also as well basically perceive low carbon strategies as more risky than the current situation. And basically in that saying that they find climate policies not credible, that they don't believe that policymakers will impose those anytime soon. And that will lead to a higher interest rate on loans for low carbon companies. And with that, the finance sector would then implicitly delay the technological conversion of these utility firms. And so the feedback loop there that we have developed, that we identified as missing, and that we have developed a solution for, is to say, well, you have the climate scenarios from the NGFS. They are great to help investors make decisions and assess their risks, to assess the economic output and the risk in different sectors and their climate risk exposures. But once these investors start acting upon these risks, and they actually start shifting the interest rates and their risk assessment, basically in the loan conditions, financing conditions for the different energy sources, they will influence what these scenarios actually look like into the future in the first place. And that is the step that is missing in the current generation of scenarios, and that we should explore to improve for the next generation. Irene, it looks like you're back. If you want to take over here for the last 2 slides, then that's fine, to focus on the enabling and the hampering methods. But since I don't hear you, I'm going to continue then. So, to make this even more explicit, the role of the finance sector in this transition can really be enabling or hampering. The finance sector can be enabling by providing more favorable loan conditions to low carbon technologies, and to support in that way the a successful and rapid transition towards a low carbon world. But it can also be hampering if the financial sector is considering in a high carbon world as more credible, or a non-climate policy world as less credible, then they will provide better loan conditions to high carbon firms, and in that sense be limiting and standing on the brakes basically of the transition. And with that, they can make the lowest scenarios clearly unfeasible, right? If we still think that a 1.5 degree scenario is feasible under sort of the best world conditions, if the finance sector then steps on the brakes and thinks that's not credible, then actually these 1.5 degree scenarios really clearly get out of reach. And so the framework that we had proposed in this paper to solve this problem is actually to link the integrated assessment model with a model for climate financial risk, by providing information about the climate, about the carbon price, and about the output of different sectors from the integrated assessment model to the financial risk model. And then on the other hand, the financial risk model will provide a financial information on the interest rate for the different technologies and sectors to the integrated assessment model, so that they converge on a stable path that is consistent between the transition that's needed in the integrated assessment model and the risk assessment that the finance sector makes. And that way, one can become very explicit about what the role is of policy and policymakers who would immediately impose climate policies, or who would delay their climate policies, and what the role is of the finance sector there in playing an enabling or a hampering role in the transition. And so then to take a step back and to broaden this up, this framework would contribute to strengthening the policy signal and the policy credibility, and it would be crucial for the low carbon transition and financial stability. It can help to develop the fiscal policies, because by neglecting the role of finance in carbon price projections, and one could actually lead to different emission targets than what was originally envisioned by certain policies. And so this coupled framework can help actually to come up with more consistent stories with the role of the financial sector in there. It can also help to strengthen financial policies, because it can help the financial authorities and investors to limit their underestimation of the financial risk in climate stress testing, and have also the role of the financial sector included in the scenarios that are used for financial stress testing. And with that, coming to the end of this presentation, I want to thank you for your attention. And this paper is indeed, as Irene already mentioned, published last month in Science, and you can obtain it there. Good, let me stop sharing and see who we have still here on the panel. Okay, so Irene was here, but then disappeared again. So we have a few more minutes for questions then on the panel. I don't see any questions in the Q&A, but if you have questions, please type them there to any of the panelists, and we will pick them up. I see a suggestion in the chat from Anna to help to refresh the page, but I think that was really oriented towards Irene, and I'm not going to try that because my experience is that I'll be kicked out of this meeting once I do that on my own computer. So one question here that now comes in here is actually, do we have the money to do all these transitions, and where should the money come from? And would there? So maybe if we interpret this a little bit broader, is there a role maybe for central banks in this? During the transition, actually, to also provide, financing and quantitative easing that makes the transition possible. Right? There's a big debate out there of people that say in this time of cheap money, where the central banks are providing that, we should take advantage of that and go through this transition. Now, I fear that might be among the topics that I should not ask Edo to talk about, but please indicate that yourself if that's a too broad thing about the role of the Bank of England that you should not be doing.
Well, I mean, that's a very lively debate at the moment, so I can't say too much. But what I can say is that the Bank of England recently put out a discussion paper on what it should do. So what is interesting is that the UK government has made changes to the remit of the Bank of England, allowing it to or requiring it to consider the UK ambition to achieve net zero emissions by 2050 in some of its operations. It's not very specifically defined, but we have put out a discussion paper on whether there are things that we could do on our own balance sheet to, I guess, that go some way to what you're suggesting, which is financing the, not financing the transition, but maybe aligning our investments somewhat with these broader objectives. But that is a debate that is very actively had right now. I don't have the answers, and I won't go into that because that's I'll just burn my fingers. But it's certainly a good question. And maybe one thing that's useful to highlight is that the NGFS scenarios that Jerome also presented show some indications of how much money might be needed for this kind of transition. So I guess that's a good starting point to start thinking about, do we have this money and where should it come from?
Yeah, thanks. That is indeed another part of the role that these scenarios can play. Jerome, do you want to say something about the investment needs as they emerge from the NGFS scenarios?
Yeah, I think quantitatively regarding renewable energy technologies, I think we will need between 3 to 4 times to increase the amount of investment by 3 to 4 times. Should we want to reach net zero by 2050? That's a key result, I think, from our NGFS scenarios, and I think this is also well in line with what the IEA said a few months ago in the World Energy Investment Report.
Yeah,
and this needs both public and private financing.
Yeah, thank you. The topic actually also echoes something that we put in one of our census modules specifically on explaining what type of information there is in integrated assessment models for financial sector actors. And there we highlighted that especially for the power sector, this transition also contains a sort of a shift in the risk profile of the power sector, because you're moving to much more capital intensive technologies. And so while investments go up in the first part of the transition, and you need a lot of capital basically to expand renewable energy and potentially also nuclear and those kind of technologies, those technologies are much more capital intensive and have a very low operational cost. And so if you look over the course of the transition, you really see a shift of the cost structure of the power sector, where variable costs like fuel costs are still playing a major role nowadays to keep coal and gas power plants running, towards a situation where you're basically almost fully dependent just on capital costs, and operational costs don't matter that much anymore, because you don't need fuel for those technologies. And so while you need these investments up front, there actually are clear benefits also once you are through the transition and you have made the investments, so that that system at that point actually can perform better and be less vulnerable also to price shocks and to other types of risks. I'm looking at the question that we got here. Do we have a tier 2 scenario if we can attain tier 1 scenario? But Nimal, maybe you want to come in and ask your question orally and explain it maybe a little bit further.
Hello.
Welcome. Yes. Hi. Now we hear you. Well.
No. I mean, when I listen to all these panels for the last 3 days, clearly it looks like when you have academics and researchers like you talking about it, you give us a much clearer and a more genuine picture of what needs to be done to get there. So it's very helpful. But at the same time, when we think about the actual investment required, I mean, it's a completely different way of thinking how we are going to get there. It's not just a private investment. It's almost like you have to run an MMT for the next 30 years worldwide to get here. I mean, there may be political sensibilities against it. I'm calling from New York City, America, and I don't think U.S. population would ever accept a 30-year MMT. I mean, that almost sounds like a socialist system to finance net zero by 2050. Now, so if we can get there, do we have a different plan? I mean, if we can't get 1.5, do we have a different plan? Or we are going to have a maximalist attitude? We are going to get there, or total bust? I mean, do we have a different plan where we can get to the most ideal situation? Can we take a step back and say, let's get to this so that part of the Antarctic ice cap will melt, and maybe we won't have what happened in Canada, British Columbia last week won't happen, something like that. That's my question, because as you said, if we don't have the money, what are we going to do?
Yeah, thank you. That's a clearer explanation of that question. So maybe one first answer, and then Jerome, Edo, you might want to signal whether you want to come in on it. But so one thing is that we should be careful to frame the climate debate as being binary, right? That if we do not make 1.5 degrees, or if we do not exactly make the 2 degrees, that then if it's 2.1 degrees, that all hell is going to break loose. Of course, there will be impacts, and the impacts will be higher if you exceed the target. But at the same time, if we are not making exactly that steep reduction that we have in mind in the most stringent scenarios, it is not the case that if we just miss that target, that we are then all of a sudden in a 4 or 5 degrees world. That is the binary choice that we have between either being very low or we do nothing at all. I think in that that gray zone in between seems much more likely that we end up there as our unintended plan B, where we will have both impacts and both cost of the transition. And
no, I think that's an excellent point. That's an excellent point. I think we might, without wanting to be there, we might most probably end up there in a middle ground somewhere less than the 2 degrees, and that's all we can do unless we are planning to print money in the basement, which of course we're not going to do. So
yeah, no, and in that sense, actually, that is, if you imagine this NGFS scenario space, that those might be the scenarios that are in the top right of that, where we are not meeting the climate target, but at the same time we have a disorderly transition in that way. And that might be the most likely corner where we end up, which basically has both of the risks of the transition side and of the impact side, but both in a lesser extent, right? You have both types of risks, but you don't have like full, don't have the physical risks of a 4 or 5 degrees world, but you also don't have the transition risk of a 1.5 degree world. You have both of these risks of a 2 to 2.5 degree world, where you have so financial sector and the whole world basically facing the risk from both sides, but to a lesser extent. Edo or Jerome, did you want to come in on this?
Perhaps just, I think I'm going to take this opportunity to ask a counter question myself, but I'll also attempt a quick answer, which is just that as a supervisor of financial institutions, our main concern is to prepare financial firms for all of these scenarios. That's why we don't have one NGFS scenario, but we have 6 kind of across that whole range. And we want them to manage the various risks from climate change, be they physical risks or transition risks, because we're cognizant that, we could get either of those outcomes, or like Bas said, a combination of both. And so to kind of segue into my counter question to the panel, I think if physical risks are going to be, increasing, and if we are going to be in a world with significant physical risk, that would presumably require us to invest in resilience and adaptation. So there's investing in the transition, but there's also investing in resilience and adaptation to prepare ourselves for the physical risks that we do get. And so I wonder if, from an economic perspective, you kind of have to look at both types of investment. I think the integrated assessment models that I've seen very much look at the investment needed to transition. But it might be helpful to put that other half of investment into the equation. And then going back to the first question, do we have enough money to do all these? It might be even more expensive, actually, if we factor that in. But I would be very interested in that analysis. And I don't know if you have anything, Bas, Jerome, that you've seen that tries to do that, tries to bring those together.
Yeah, thanks, Edo. We are in one of our Horizon 2020 EU projects in Navigate, actually working exactly towards this question on defining the investment needs for adaptation towards climate change. And so to have the information available there, it is traditionally sort of weighing the mitigation versus adaptation question has been the domain of the simple integrated assessment models like DICE and so the cost-benefit assessment models like DICE and FUND. But those are not so detailed in their representations, very aggregate in their representations of the systems. Now, indeed, integrated assessment, the more process-based integrated assessment models are moving in that direction to also bring together that information. There we should be really cognizant of the risk that we are not able to include all potential damages and adaptation in these kinds of models. So it's very easy that you focus on the water, land, energy related impacts, but that other impacts, like for example, tourism changes or ecosystem changes or some are not included, and therefore you sort of underestimate the damage risks in these models. So that's where there's great reluctance actually to go too far in that direction, because once you become explicit about all of the risk, you need to really make sure that you cover all of the risks in your cost benefit analysis. And yeah, I see there was one question also in the Q&A, and then we should wrap up on given the importance of the finance sector and how it's located in cities. That's an intriguing question in how that it might be important actually to highlight the impact of climate change on those cities, because that is where important people in the financial sector are living and have their have their livelihoods, and how it can actually potentially bring them to action and move the financial sector more than if you would sort of give these global pictures of where how climate change could be impacting the world overall. I find that an intriguing direction actually for next phases and thinking about other impacts of this with these scenarios, to highlight a bit more the places where the financial sector is located.
Could I make one observation on that, Bas, which is just that, I mean, I think it's a very good point, very good comment. I think the majority of the risks that financial institutions face are actually through their exposures, which could be anywhere. So, based here in London, and the banks here in London, well, maybe, if we're very unlucky, we might suffer from flooding in London and such kinds of things. But these banks also have, and insurance companies, investment companies, they also have data centers nowadays located in various places around the world. So where are those located, and how could those places be affected? They might work with tech companies to use their cloud services. Where are those functions located? And then more than that, they have mortgage exposures through their lending all over countries. They invest in businesses all over the world. So I think actually the global picture of impacts is already very relevant, because financial firms are going to be affected largely through their exposures. And that's probably a much bigger share than their direct exposure to their own buildings and to their own people.
True, that's a fair point. Okay, we have run over time for this session already quite a bit. I want to thank all of our speakers, Edo Schetz, Jerome Hilaire, and Irene Monasterolo, even though we had to do without her for much of this session. Thank you for your contributions. It was a very interesting session, and thanks to the audience for joining us. And I hope you have enjoyed the Vienna Energy Forum the past few days, and hope to see you at next editions. Thank you.